We have a new Fed chair. 30 minutes till the start of the trade. I'm Matt Miller. Danny Berger is off right now. Bloomberg Open Interest starts right now. Coming up, he is the chosen one. President Trump taps Kevin Warsh to lead the Fed, a choice viewed as more hawkish than other contenders. And a busy week for earnings season wraps up with the bullish forecast from Apple and a strong result from big oil. And metals mania, gold and silver, suffered their biggest slide in years as wild swings rock the commodities market. Let's take a look at some of the stocks that we're watching. Are they here? No, they're here. I'm going to walk over here. Apple is one of those, blowout results, and you're going to hear about this over the next couple of hours. Record quarter. We're concerned about costs for things like memory chips, but we knew that before the report. So why isn't the stock doing better? Well, Apple stock doesn't tend to move a lot after earnings anytime. Tesla trading right around 420. We're looking for that big round number for Elon Musk. SpaceX is considering a potential merger with Tesla, according to people familiar. You could have guessed that. It's fairly obvious. That's clear what they're going to do to get the market cap up to $8.5 trillion so that Elon Musk can get his $1 trillion pay package. SanDisk rockets higher, surging after a huge revenue beat. It is up more than 127% so far this year, and we are still in January. Here's how markets across assets are reacting to Kevin Warsh as a pick. Well, I don't know if you can pin it all on Warsh, but the S&P futures are down about 0.5%. We were at 69.69 at the close yesterday. We're looking at a steepening curve. The 2-year yield down just a little bit, 355. The 10s and the 30s are up. And the Bloomberg Dollar Index right now bouncing back a bit, 1183. This compared to its G10 peers, looking a little bit stronger, but of course it had fallen to a 4-year low before that. Neil Dutta of Renaissance Macro says Warsh was the weakest option Donald Trump had.
It's not so much that he's hawkish, it's that he's always hawkish. And always, typically when he's wrong in the same direction. I mean, what you want in these positions is someone that has an open mind, that's a flexible thinker. So I think his newfound dovishness looks very suspicious. And, maybe that's one reason why Powell sticks around past May. If he does, he'll be a weak Fed chair. And even if he doesn't, he'll probably be a weak Fed chair.
Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. And I'm not sure that Neil's opinion is representative of the market, but, we've been following Renmax so closely and what Neil had to say, so I think it's interesting to hear his take. How do you think the market is going to perceive Kevin Warsh? Because we don't really know if he's still hawkish, right? I mean, J.D. Vance once didn't like Donald Trump, but now he's fully on board. So,
well, Warsh has been moving to the dovish camp for more than a year now, and perhaps it was with an idea to becoming the Fed chair at some point, but he has been making the case that the economy can grow faster with lower inflation, which would allow for lower interest rates. He does have some strengths. His monetary policy background will serve him well in terms of understanding how the whole system works. And of course, Wall Street, they may be trading a little bit knee-jerk today on the old hawkish view of Kevin Warsh, but he does have a Wall Street background. He started at Morgan Stanley. He's been working at Duquesne since he left the Fed in 2011. He is a harsh Fed critic. He wants to make some changes in the way they operate, which will be interesting to see if he can get through. He thinks the Fed should concentrate on inflation, keeping inflation down. But if they can keep inflation down, then you have room to cut rates more. He's a critic of QE, so don't look for that as a way to bring rates down. The Fed is guilty of mission creep. He thinks Fed officials over-communicate. I don't know if he can get them to be quiet now. That genie may be out of the bottle. And he's kind of willing to give up bank regulation if he needs to. He was very critical of the Silicon Valley Bank failure and how that was handled. The Fed is something that is ripe to be fixed. Kevin Warsh has said the Fed's current wounds are largely self-inflicted, and its plot armor is showing its wear. A strategic reset is necessary to mitigate losses of credibility, changes in standing, and most important, worse economic outcomes for our fellow citizens. So Warsh,
he's a critic.
Warsh is a critic, and he's ready to take over and make some big changes. One of the people who did not get the job was Chris Waller. And Waller was one of the dissenters this week at the Fed meeting, and he has now put out a statement explaining his vote. He says it's important to look through tariff inflation. It's a one-time thing. There's substantial risk the labor market weakens, he says, so further easing is needed. And he has this kind of quote, which is kind of interesting. He says, let this sink in for a moment. Zero job growth is basically what we've had versus an average of almost 2 million for the 10 years prior to 2025. This does not remotely look like a healthy labor market. So if Kevin Warsh adopts the Chris Waller view, then we could see further rate cuts coming forward.
I'm going to save that Waller quote for the next time I interview a labor secretary. By the way, I wonder if Jerome Powell leaves, because he could stay at the Fed for longer, right? Not as chair, but as member of the Board of Governors. Is he now less likely to leave since Jeanine Pirro has started an investigation into the Fed and subpoenaed him?
Well, in one sense, yes, because if Tom Tillis carries through with his threat to block the nomination,
which he confirmed on surveillance this morning that
yes,
he will,
because of the Pirro investigation, then Powell can stick around because they need somebody to run the place. Now, his term ends May 23rd, but the president could make him the temporary chair if it's a matter of days or something like that. They did that the last time. Chair pro tem was what they called him. But really the question is going to be up to whether Powell thinks that Kevin Warsh is enough of an institutionalist that even if he wants to make changes, he's going to do so respecting the importance of the job that the Fed does. We don't know yet what he thinks of this, and we don't know whether he's going to leave. I don't think we're going to find out for a little bit.
Or maybe Powell just wants to chill. Like, he's worked for a long time in his life. He might want to just retire. A feeling I understand. Mike McKee, thanks so much for joining us on that. We'll no doubt continue to be talking about who is Kevin Warsh for a couple of weeks at least. Turning back to big tech earnings, Apple posted a blowout quarter, but shares, well, they're relatively muted after the company warned rising component costs are threatening to squeeze margins. Bloomberg Tech's Ed Ludlow joins us out of San Francisco, and it's not a warning we didn't know about before the release. I mean, this was something everyone knows, and yet it seems to have Apple shares contained in a very narrow range, Ed.
Yeah, it's a dampener, right? In a blowout quarter gone where clearly the latest iPhone generation has had traction and sales for iPhone, not just on like a dollar term, $4 billion beyond consensus, but percentage term, the most bullish estimates on iPhone were about $81 billion in the quarter. $85 billion is what they posted, but there was no impact, or Apple managed the impact from memory much better. Then you go to the outlook for the current period at the high end, 6 percentage points beyond consensus. Like, that's big, right, for Apple. But an acknowledgement that what is happening in memory markets, particularly on pricing, is going to impact margins. And you know, how many times have we said on this program, Matt, that like Apple is the master of managing the bottom line? The other part of the story is that there was loads of good news that masked or papered over the lack of artificial intelligence news, which they were never going to share anyway. But the market has high hopes.
All right, so Apple, I mean, knocking the cover off the ball, but the shares don't tend to move that much after earnings. Yeah. I saw the S&P closed at 69.69 last night, and I immediately went to check to see if Tesla shares closed at 420. They were near as damn it to it. Elon Musk, in a scoop that you put out last night, is considering combining SpaceX, maybe XAI, and Tesla, which makes sense, right? Because that would help to boost the market cap, and he needs to get it up if he wants his $1 trillion pay package.
It makes sense to a lot of people, but I want to be absolutely clear. What we reported is that under consideration are two distinct scenarios. The new bit, the news, is that SpaceX and Tesla have discussed what a combination between those two would look like. And my understanding from sources is that there is a large body of investors that have really pushed that option. Alternatively, and at the same time, SpaceX and XAI, two private companies, have looked at a combination too. On both options, this has been hypothesized by many. On the Tesla SpaceX option, Bill Ackman, Chamath Palihapitiya have both put that out there. This is Bloomberg reporting that the parties involved have talked about it. And the market reaction sort of spoke for itself in after hours.
Well, I mean, eventually they'll all get together to form an $8.5 trillion company. That's at least my assumption, for what it's worth. Ed Ludlow, your program kicks off at 11. We'll be there with you and Caroline for sure. In other earnings news, Chevron and Exxon both beat estimates as higher production offsets lower oil prices. Bloomberg's David Wethy joins us now for details. So, David, it was obviously a soft quarter, to say the least, for the underlying commodity, but I guess they're boosting production to help save the bottom line.
Yeah, exactly. I mean, that's going to help them right now. And it's going to be interesting to watch going forward. Already, we've gotten a little glimmer of what to see in the Permian, which has been a growth driver for Exxon. They said in transcripts for what they prepared to say on the call later that for first quarter of this year, Permian production will drop for Exxon. So that's interesting to watch. And it could be something to watch for the rest of the shale producers as they maybe look for a reason to drop production amid lower crude prices. For Chevron, they say that they plan to maintain this 1 million barrel a day oil equivalent production in the Permian, so sort of like flatlining, not exactly growing anymore. So again, that's something to watch. While the growth of crude production helped them up to this point to mask lower crude prices, what will it be for them going forward?
I think everyone was watching, David, Darren Woods or Exxon to see if they would say anything to counterbalance the doubt that Woods sowed in Venezuela as an investment thesis. Did you hear anything along those lines?
So far, nothing from their prepared remarks, but he did say on CNBC that a little bit further details on why they see it as uninvestable, mainly that the previous leaders, Chavez and Maduro, did major damage to the economy and the oil industry in Venezuela. And in addition, that Exxon was pretty upset that the rules of the game had changed and contracts were not being enforced. So for that reason, they pulled out of Venezuela and have not gone back. So we'll see what else he says on the earnings call. Surely analysts will have questions about that. All
right, David, thanks very much for your reporting. David Wethy covers the oil industry for us out of Houston. Quick check on what's going on in the futures market. Right now, S&P futures remain weak, off 0.4% after a mildly weak close yesterday. We were only down 0.1% at the close. NASDAQ futures down 0.2%. And Russell futures, the small caps, losing more than 1% in the futures market. Let's get a look at some of the single stock stories that we're following for you this morning. American Express reported a boost in customer spending, and it will boost its dividend 16%. That's not enough to help the shares right now, down 2.33%. Verizon reported its biggest gain in mobile phone subscribers since 2019, plus authorization of a $25 billion share buyback. That's enough to help drive the shares up 5%. And Deckers soaring this morning after it raised annual earnings and sales forecasts above the average analyst estimate. Deckers, which makes UGG and Hoka shoes, up almost 15% in the pre-market. Coming up, more on Kevin Warsh's nomination with Julia Coronado, a former Fed economist who now runs macro policy perspectives, and our own Annmarie Horden after talking to Senator Thom Tillis on whether or not he'll block the confirmation. This is Open Interest.
We'd still have a working quorum of members. Whether or not they have an acting chair is a decision that the president and I assume the Treasury Secretary and others can look at. But that's not my problem. We're here because of them. We're not here because of me. And so I think they should work expeditiously if they really do. I'm not an attorney. I watch a lot of crime shows, but it doesn't look like there was any criminal intent here. They have to determine whether or not it's worth grinding this out.
That was Senator Thom Tillis telling President Trump who really holds the cards. He says he will block Kevin Warsh's nomination until the investigation into Jerome Powell is over. Let's bring in Bloomberg's Annmarie Horden, who had that guest on Bloomberg Surveillance this morning. So pretty strong stuff there from Thom Tillis, saying it's on them, it's not on him.
Yeah, he's not backing down. And he said this to me, John and Lisa, as well in Davos. He was talking about the fact that it's not about the person, it's about the process. And until the DOJ investigation into Jay Powell and the Federal Reserve is wrapped up, he is not going to move on whoever the president was going to pick as his new Fed chair. Now, when it comes to the person, actually, Senator Thom Tillis had a lot of nice things to say about Kevin Warsh and thinks this is a credible individual. There's been a lot of pushback on some members of Wall Street who are saying this doesn't really match up with what the president was looking for. Of course, you talked about this with Mike McKee in terms of the fact that this is an individual that is an inflation hawk and was calling for interest rates.
Let's say was an inflation hawk.
Okay, that's fair. Maybe he's changed over the course of the last few years. He clearly has, I guess, in the sense for the president to pick him. But when it comes to the process, there's really no timeline. We don't know when this DOJ investigation is going to be wrapped up. And there are reports that actually the Federal Reserve has not replied with the subpoenas. And potentially that means that Jay Powell could be in the driving seat to drag this on a lot slower. So there's really no timeline on when we're going to get a hearing, and then potentially we would see a Fed chair, Kevin Warsh.
By the way, Thom Tillis, a Republican, is not a never-Trumper. He doesn't have TDS, right? He has fought the president on a couple of issues, but he also supports President Trump on a number of things. And he's not up for re-election, I think, is the most important part, right?
Yes. So he says basically this is going to take, as long as the process takes, the DOJ has to wrap this up in terms of the investigation, or 339 days, because that's how many more days he has left in his term to serve as senator of North Carolina before he retires.
And as a member of the banking committee, right? This is why.
Senior member of the banking committee. Yeah. That's why. And then Senate Majority Leader John Thune was asked about this last night. Do you think you can move ahead without Senator Tillis? And he was like, probably not. So Tillis is really key here. Tillis also talked about in that interview about he wants to see the Supreme Court case on Lisa Cook also wrapped up before he moves forward. Then he clarified he moves forward specifically for her chair seat if there was going to be another musical chairs when it comes to the Board of Governors. But it's really key to remember that this could be a very long process, even though the president has made his choice.
All right, excellent reporting, Annmarie. Thank you very much. Fantastic program today.
Oh, thank you so much.
Bloomberg
thanks
Surveillance
for
co-anchor Annmarie Horden. I watch it on my phone. Let's bring in Julia Coronado, a former Fed economist who now runs macro policy perspectives out of Austin, Texas. And I mean, first off, can we know much about Kevin Warsh? Because so many people in the president's circle really make a huge shift in order to endear themselves to Donald Trump. So, I mean, it's unclear whether or not he's still an inflation hawk, isn't it?
Yes, I think it is. I think the short answer to your question is yes. It's hard to know what will actually happen when Kevin Warsh is confirmed and in the seat. Kevin Warsh does have experience as a governor and knows all too well the challenges of engineering and forging a consensus amongst 19 opinionated independent thinkers, and he will have to confront that still. So, he sort of has to shift his position, as you note, to get the job. Once in his seat, he's going to have to contend with the committee like any other Fed chair, and look at the data and deal with different opinions. And, he faces the uncomfortable situation of, if you don't have a majority of the committee favoring lower rates, are you going to dissent from your own policy as Fed chair? That would be unprecedented. Or are you going to disappoint the president? That may be the difficult situation he finds himself in.
And this, I just am reading a message from Joe Brusuelas at RSM. He writes in to remind me that Kevin Warsh had some pretty radical views on balance sheet reduction. And I wonder if he maintains those views, especially considering he was active on the Fed, 20 years ago when the economy was much smaller. Maybe a larger balance sheet is necessary to deal with a $35 trillion economy.
Yeah, I mean, he was he was a balance sheet hawk. I mean, that was one of his core positions, that he just QE did not sit right with him. He was very uncomfortable with it, even in the depths of the global financial crisis. So, you know, I think it seems like he would be amongst the 4 candidates that were under consideration, the less likely to be interventionist on the balance sheet. And in any case, any kind of shift in balance sheet policy will also require that the New York Fed president is with you, that the committee is with you. So we don't really know what his position will be going forward, and whether he will be willing to use the levers of the balance sheet to try to engineer lower rates. But more importantly, would he even be able to, is the question. And I think that in any scenario, whether Powell leaves or stays, whether Waller leaves or stays, and whether there's a bigger rotation or a smaller rotation in personnel, it's going to take some time for Kevin Warsh to effect a plan of action that tries to engineer lower rates, particularly given the current state of the data. Of course, if the labor market were to wobble and we were, you know, the economy looked shaky, you know, you'd have a lot of support for lower rates and possible balance sheet intervention, but that's not where we are right now. So we don't know where we'll be in June when he takes over. So the data could, you know, help his case, or it could get in his way.
I remind viewers that you spent many years at the Fed after doing your PhD at UT, and I wonder what is your take on where we are right now? I mean, do we need lower rates? How does the labor market look to you? The Fed seemed pretty sanguine about that. And how does inflation look to you, Julia?
Yeah, I mean, you know, we just got a statement from Governor Waller on the labor market kind of saying, you know, we had basically, once we get the benchmark, no job growth in 2025. Does that look like a healthy labor market to you? He used some spicy language. But I think, you know, it's not clear that we're out of the woods on either side of their mandate. I think a pause is perfectly sensible after the 3 rate cuts, given the constellation of data, very strong GDP tracking, some signs of stabilization in the labor market. So the unemployment rate ticked lower. It's drifted higher over the year. ADP tells us that we're seeing modest positive private sector job growth. Indeed, job postings have sort of stabilized and drifted a bit higher. So there are some indications that the labor market may not be on the same downward trajectory it was through most of last year. So pausing and gathering more information, I think, is perfectly sensible. In fact, I think absent some of the politicization, it would have been a unanimous decision, because it's not that controversial after 3 cuts to take a pause and see how the data pans out.
Right. And
I don't think that.
And really, we're down even more than that if you look since September of 24, right? I wonder about inflation, and I'm always worried about it. I worry about everything. As a journalist, I feel like it's partly my job. But we're getting supposedly big tax reductions, 15 to 20% higher than, refunds, higher than we had a year before. We have tax reductions, right, especially for the wealthy who do a lot of the spending. President Trump wants to cut stimmy checks for the masses as well. And, you know, 3% inflation, I also wonder, Julia, that seems a lot worse after 9%, right? So, like, is there any chance that we can average our way down to the Fed's target, or is that just, we just blown past that?
No, I think it's going to take some time to get to 2%, even under good scenarios. You are very correctly pointing out that we've got some fiscal expansion, and that fiscal expansion could be inflationary at a micro level. For example, we hear that automakers may try to use that tax refund season to push through some of those higher costs they've been facing because of tariffs. We'll see how that plays out, but we could see some transmission from that fiscal support or a fiscal expansion into inflation. That's entirely possible, and I think the risks are certainly tilted in that direction. If you've got more fiscal easing, you need less monetary easing. That's pretty sensible. I
got to cut you off for a break, but I really appreciate your time. Macro Policy Perspectives founder and president, Julia Coronado. Moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are, frankly, coming back a little bit as the market tries to figure out who is this Kevin Warsh and what are we going to get from him. S&P futures still down, but only 0.4%. We were off about 1% a couple of hours ago. NASDAQ futures were off more than that. Now we're down 0.2%. So a bit of a recovery. Even the small caps are back at less than 1%. And look, we have curve steepening, so they should be happy about that. You've got a couple of nonprofits ringing the opening bells at the New York Stock Exchange, the American Heart Association. They look fantastic. And down at the NASDAQ market site, you've got the Fashion Foundation, and I'm sure they do good things for the way we dress. In terms of the market, Apple shares right now down 1% in the cash trade, and this after a blowout quarter, after $85 billion in revenue, after the iPhone climbs to 2.5 billion users as far as the installed base is concerned. So this just on concerns about costs that we knew about going into the report, but Tim Cook confirmed that memory chips are getting more expensive. Tesla right now up 3% at 12. A gain of $12.97, almost $13 at 4:30. This on Ed Ludlow's reporting, along with his whole team, that they're talking about maybe combining SpaceX with Tesla, maybe XAI, and SanDisk just continues its incredible march higher. A gain of 23% in one day. It was already up 127% for the year, and we're not quite to the end of January. Yeah, joining me at the desk is David Lefkowitz, head of U.S. equities at UBS Global Wealth Management. And David, I guess, the question the market's trying to figure out, trying to answer this morning is who is Kevin Warsh and what's it going to mean for the Fed? So I guess what's your take on that would be my first question to you. And then 1B is how much does that matter right now?
Yeah, sure. No. Yeah, look, I think it's going to take the market some time to figure out exactly who Kevin Warsh is, sort of what the new maybe reaction function is from a Kevin Warsh-led Fed. But I think it's important to stress the led part, right? There are lots of other members of the Fed. Fed Open Market Committee obviously comes together to set policy. And so Kevin Warsh is going to have to generate consensus to really get specific policies that he wants. I would also not lose sight of the fact that at the end of the day, the Fed is guided by its statutory mandate. Its statutory mandate is full employment and stable prices. And so I think what we're really talking about is some of the details and nuances about the policies that will be employed, how to get stable prices and full employment. And so big picture, I don't think there's a tremendous amount of change, but the market still wants to get more comfortable with the Warsh-led Fed.
We also, you summarized the main market drivers as a resilient economy, a supportive Fed, and AI investment and adoption, right? So the Fed is only one, I would submit, weak third of that, right?
I think the Fed is very important at the end of the day, right? The monetary policy setting is very important. Remember, go back to 2022, we had a Fed that was tightening the screws quite aggressively, and that was a difficult time for markets, for equity markets. And since then, we've had a Fed that has been easing policy, and I think that's part of the reason why we've had some good returns. Obviously, AI and resilient economy are very important as well. So it's part of the stool. I think it's very important. I guess my take is that, are we going to get tighter policy because of the change at the Fed? I don't really think so. So therefore, I don't think this supportive Fed environment really changes.
It's unthinkable that President Trump interviewed these four candidates and installed one who's going to give us tighter policy, isn't it?
I think that's right. Although, I would say the market gets a vote in policy, right? Yeah. If the Fed is doing things that the market believes are unproductive, unhelpful, you're going to see those signals in the market. And so the Fed does not operate in a vacuum. The market is part of the conversation. Let's
talk about the AI investment, because we've seen a slew of earnings this week that show us increased CapEx. Sometimes the market's happy about that. Sometimes it's not. As as illustrated by the duality of Facebook and Microsoft. And we've also seen a lot of the picks and shovels businesses do incredibly well. I was just talking about SanDisk, right? These memory stock, these chip makers soared last year and continue this year. So what do you think about those businesses?
Yeah, a couple things. I think really what we're witnessing, and I think this has been the story over the last couple of years, is that it's the market response is going to where the shortages are, right? I mean, initially we had shortages of GPUs, and also just, the numbers were much higher than what people were expecting. Now the bottlenecks are in memory and maybe other parts of storage. And I think you can even extend that even to the industrial side, right, where we're seeing the metals and things like that. So I think that's definitely part of the story.
So now, where's the next shortage?
Well, yeah, I mean, I think we've seen, right, you've seen in semi-cap, you've seen, I think we're going to continue to see numbers go higher there. I think some of that is being priced in. But also I think what we have a shortage of is sort of the applications that are going to run on AI, right? I think that's still a huge opportunity. And we don't know who the winners are going to be, what the precise types of use cases will be out there. And so we've been tilting our portfolios into that direction. And admittedly, it's a pretty open field at this point, right? Who's really going to be the winners on the application side? Now, on the CapEx point, I think the market is making a very clear distinction. If companies that are raising CapEx are also beating on revenues and projecting higher revenues, the market is giving that a green light. If the market has questions about the revenue performance, in other words, the return on that spending, then the market has a more mixed reaction, I would say, to CapEx increases.
Are there any other companies? Are there any sectors that aren't AI right now? Because everything has turned tech.
It's true. I mean, look, at the end of the day, Matt, I mean, virtually every company and all consumers use information technology, right? So I think it's just a matter of degrees to some extent. But one area we think is really interesting is healthcare, where we think we could see some real breakthroughs that come through deploying AI technology. And obviously we haven't seen that yet, right? But there's we think a lot of fertile ground in terms of drug discovery, in terms of getting the right therapies to the right patients who need them. So potential for lots of innovation and efficiency, and that's not priced in to the healthcare sector. So to us, that's a great diversifier at the same time that there's still a lot of excitement going on in sort of this AI infrastructure build out.
Well, we hope you're right about that. I think everyone hopes that healthcare takes great advantage of this. David, great to get some time with you. Thank you so much for coming to 731 Lex. David Lefkowitz there, UBS Global Wealth Head of U.S. Equities. Let's get a check on what's going on in the markets now as the cash trade settles in. We're looking at a drop, but it's only 0.25% now, 18 points on the S&P, 69.50. The level here, we closed at 69.01. Yesterday, we're looking at breadth to the downside, so 200 stocks up, 300 stocks down right now. In terms of the winners, Tesla is one of them. On Ed Ludlow's report that they are in talks, at least, to figure out what it would look like if they combined SpaceX and Tesla or XAI, and that obviously makes sense because Elon Musk needs to get the market cap of Tesla from $1.5 trillion to $8.5 trillion if he wants to get his $1 trillion pay package. Broadcom, Micron, SanDisk, all these tech stocks are rising, and Verizon also doing quite well, up 6.5%. And then, as David was just talking about, you've got some drug makers, Eli Lilly, right now only up 1%, but it's such a big company now that it does add to the S&P. Apple is down 1.33% after a blowout quarter, but Tim Cook said these higher prices for stuff like memory chips are going to impact margins. Meta is down a little bit as well, 2.25% right now, taking 4% off the index, and Nvidia takes 2.25% off with only a 0.4% drop. Take a look at the sector breakdown in terms of the GRR. That's how I get to this screen with the S&P index. You can see that more sectors are down than up. Healthcare, to David Lefkowitz's point, having a good day today, up 0.4%. Consumer discretion, industrials also are up, although not by much. On the downside, you have materials as this incredible collapse in the price of gold, silver, and copper. I mean, yesterday we climbed up through 5,500 in gold, and then this morning came down through 5,000. Yesterday we were up through 14,000 in copper, and today we came down to 13,000. So that's why you see the weight there. Coming up, more on Apple's mounting margin risks with Barclays analyst Tim Long, who is now underweight the stock. This is Bloomberg Open Interest. Time now for our top call, some of the analyst action that is in focus this morning. First up, Citi upgrading Spotify to a buy, pointing to positive catalysts ahead, including price hikes in Europe and accelerating buybacks. You can see Spotify up 1.8% in the cash trade. Next up, Raymond James upgrading SanDisk to an outperform, better late than never. They see opportunities for further upside driven by AI demand, and it is happening now. Finally, JP Morgan raising its price target on Apple to $325, saying the company's earnings report should calm investor nerves around higher memory prices and a services slowdown. Apple also getting upgrades from Maxim and KGI securities, and I guess it's a decent day to buy the stock because today it's down 2% in the cash trade. Let's bring in Barclays analyst Tim Long on this. He was or has an underweight rating on Apple, and Tim, you know, the quarter was pretty convincing. If you already kind of had factored in the higher prices for memory chips and maybe a services slowdown turns around with AI, what do you think about what Tim Cook had to say last night?
Yeah, thanks for having me. I would say, yeah, there were definitely some positives in the quarter. It is interesting for such a large company like Apple. You know, the supply chain was indicating there would likely be some iPhone unit upside, and they did upside there. Only takes a handful of million of units to move the numbers for a company like this. So that was clearly a positive. The China numbers obviously spiked a lot, but a little bit concerning to us how much those numbers are up after being down so much. The services side was resilient. So that was definitely a positive that they maintained that growth. For that line, there's a lot of regulatory risks, a lot of other things going on there, but yeah, those were both positive. And I'd say the gross margin, I think Apple definitely has different types of arrangements with the supply chain. So generally speaking, they fare better in times like this, certainly in the near term when they probably have guaranteed supply. If this lingers another 6-12 months, then you're likely going to see a little bit more of an impact hitting the Apple model.
How difficult is it to stand out from the street, Tim? I mean, I'm looking at the consensus, 41 buys, 17 holds, and only 3 sells on this stock. You know, how do you work up the courage, and how long can you stay there?
Yeah, we put that rating on about 2 years ago. So, you know, we've always struggled with the multiple a little bit here. Our view is, you know, the growth days are largely behind us. You know, the last 3-4 years we've been seeing, you know, low, mid single digit growth for this company. Obviously, this last quarter gets fiscal 26 off to a pretty positive note. Last, we haven't spoken about it yet, but, you know, as far as AI goes, they're really, you know, struggling to prove to us what the model is going to be here. So I'm sure we'll start to see more indications of that as we move forward with some of their events. But I do think, broadly speaking, we do need to believe that over the mid and long term, Apple will be a bigger player in AI than they currently are.
Is there any chance, Tim, that Apple ends up looking, you know, Toyota smart here? I say that because Toyota didn't invest in EVs, and everyone was like, oh, these guys are so stupid. They're going to be last on the EV, you know, shopping list. And then it turns out nobody really wanted to keep buying EVs. So, I mean, Apple didn't invest in an LLM, but maybe they can just use Google's, and who cares, like, who provides it, as long as Siri has it.
Yeah, they're coming from a tough position because I would say the brand name for Siri isn't really that strong. And, you know, it's TBD if owning your own AI infrastructure or not is really a differentiator. If they're using Gemini, others will be using Gemini, and obviously Google will. So is there a level of differentiation or not? That's what we're going to have to determine as these features and applications roll out to see if there's anything in there worth paying for. Of course, Apple has the benefit, you mentioned this earlier, of a massive install base and ecosystem. So 2.5 billion devices, we think 1.2 billion or so iPhones in their base. So they certainly have a very large base to sell into. Now they just need to prove that this asset-light approach plus the ecosystem is enough for them to generate services that we will pay for.
All right, excellent clarification there on the installed base, 1.2 billion. Our iPhones out of the 2.5 billion total devices. Great to get you on, Tim. Hope I can get you in the studio next time. Barclays Senior Equity Research Analyst Tim Long talking to us about Apple and his courageous call. Coming up, we discuss the outlook for metals and more with Wasif Latif of Sarmaya Partners. He joins us next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks. It is Friday, thank goodness. But we're down a little bit. S&P 500 only off 0.2%, 69.53, the level right now. NASDAQ 100 down about 1/3% at 25,787. So we're still very close, to record highs here. We did go through 7,000 a couple of days ago. Couldn't hold it, but a lot of people probably have sell orders at that big round number, and we're pretty close anyway. Take a look at NVIDIA. It has now turned higher. It had been lower, so that's a weight off the S&P's back. Only 0.1%, but every little helps. Apple still down 1.7%, and we just talked about the blowout quarter that they had. SanDisk continues to climb. 17% after 120+% gain year to date. So month to date, Chevron is up after earnings. You can see silver down, gold down, and this is really the story I want to focus in on right now. Let's bring in Wasif Latif, Chief Investment Officer over at Sarmaya Partners. And Wasif, you have really been hitting all the marks with your ETF lens on this commodity investment, making a ton of money over the last couple of years for your clients and for investors. But yesterday we saw some incredible volatility. What do you think caused gold to spike up through 5,500 and then drop back down through 5,000?
Thanks a lot, Matt. It's great to be here again with you. The market was really excited about gold and silver, given the debasement trade over the last couple of weeks that really was driving up the speculative element of this. And today you're getting the wet blanket of the Fed nomination and the dollar rallying. And because of that, you're seeing a pretty significant pullback. To us, this is a healthy sell-off and a healthy correction within the context of a much longer-term secular bull market, not only in precious metals like gold and silver, but also, as we call it, the tangible areas of the market, which are broadly commodities, including energy, including other base and industrial metals that are really going to widen out and become a full-blown commodity supercycle over the next several years.
So you're still a buyer at 5,000. I know your ETF has basically doubled since its inception. Do you continue to pile into this strategy?
Yeah, so that's a really good question. So day before yesterday, it was our 1-year anniversary for the ETF. And what a day to mark the 1-year anniversary. We hit 100% return. In terms of the positioning, we're actively managing everything that we have in the portfolio. We have some sub-themes and gold and precious metals and silver and the mining stocks of those companies. They reside in our geopolitical and fiscal risk sub-theme. And then we have our Energy is Life sub-theme, where we have oil and gas companies. And then we have our Build the Future sub-theme, where we have other companies like copper miners and platinum miners and iron ore miners. So to answer your question, we have been heavy overweight in gold and silver running up to this. And as early this week, we were actually trimming some of the positions in that space to reallocate back to energy, which look much more attractive. So we're actively managing these exposures. Gold, silver, and their mining companies still remain a large part of the portfolio. A few years ago, the portfolio was much more overweight in energy, and we switched that around in mid-2024, late 2024, and that's been a great call. And we think that the next year or towards the second half of this year, energy might be the bigger play. And so we're actively managing those exposures. Currently, we're still overweight from our secular view on gold, silver, and their mining companies, given the geopolitical and fiscal risks that are still front and center.
So that's a great clarification. So you're not necessarily married to the metals. You could go to other assets, and I noticed that you can operate in all different regions as well. Are you always,
Yep.
You're always talking, though, dollar-denominated assets, right? So the dollar debasement trade that you mentioned at the top has to be something you're watching really closely. What do you make of Kevin Warsh as a new Fed head, and what do you make of the sell-off in the greenback?
Yeah, so today is a rebound in the dollar because of the news. And, this is the initial market reaction in our view. I've been in the industry long enough, and you've been covering this stuff long enough to know that the first day move isn't necessarily the permanent move. And so, in our view, the dollar bear market is still intact. It will take several years to really come to its fruition. We are not necessarily in the de-dollarization camp. We've sent you some charts. If you look at the Dixie going back several decades, there have been about 3 different bear markets in the dollar since the 1960s. And we think we're in another one for now. But, as you know, secular bear markets still have moves on a short-term basis. So we could get a rebound in the dollar, some strengthening, not just on this news, but potentially if we get an economic slowdown and there is a bit of a flight to safety and people are concerned, you could get a rebound in the dollar. Having said that, on a longer-term basis, we still think that a dollar bear market is still intact.
Got it.
And as a result of that,
got it. Wasif, I got to cut you off there due to a break. Sarmaya's Wasif, Latif, thanks so much for joining us. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller, and it's Friday, which is a great thing. And we have a new Fed chair. We're going to talk about the chosen one. President Trump tapped Kevin Warsh to lead the Fed, a choice has been viewed as more hawkish than some of the other contenders. We'll debate whether that's true. A busy week for earnings season wrapping up with a bullish forecast from Apple and strong results from big oil. Nonetheless, those shares not exactly on the rise this morning. And Starbucks turnaround plan is taking hold. The CEO, Brian Niccol, will join us here on Open Interest with Romaine Bostick later this hour, an interview we're all going to pay very close attention to with a cup of coffee. We begin with our top story, though. President Trump named Kevin Warsh as his Fed chair nominee. Julia Coronado of Macro Policy Perspectives weighed in on his pick.
It's hard to know what will actually happen when Kevin Warsh is confirmed and in the seat. Kevin Warsh does have experience as a governor and knows all too well the challenges of engineering and forging a consensus amongst 19 opinionated independent thinkers, and he will have to confront that still.
Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. So, Mike, you've been up all night dealing with this. I heard you on Bloomberg Radio last night talking about it. What do you make of the pick? And isn't it surprising that he chooses the one who's perceived to be the most hawkish of the 4 candidates that he had?
Well, Warsh has been moving towards the dovish side for a year or two now, and he's been telling the president that he's stayed in touch with him since he was considered for the chair's job in 2017. And he's made it clear that as far as he's concerned, the Fed should concentrate almost entirely on inflation as opposed to other aspects of managing the economy. And recently, over the last year, he's been writing that the Fed should be cutting more because the economy is slowing down. He doesn't want to do that by using QE. So don't look at the long end. He wants a smaller balance sheet, but he has been critical of the Fed's mission creep, and he thinks Fed officials over-communicate. Can he change any of that? I'm not sure. He's also critical of the way the Fed has supervised banks and would make some changes there. The real question is, does it affect Fed independence? He's been talking about operational independence for the Fed because he's willing to consider coordination with the Treasury, maybe some bright lines on who does what, but also some areas in which they can work together, which leaves us with the bottom line question of how low can interest rates go. And he's saying AI, capital investment, and the deregulatory agenda of the administration make it possible to have faster growth, lower inflation, and also, therefore, lower rates.
Julia Coronado earlier mentioned something I had never thought about. It is possible for the committee to vote, say, to hold rates and the chair to dissent. But has that ever happened?
It did happen back in the 1930s when Mariner Eccles was the chair, and nothing has happened like that since.
Well, they named a whole building after him.
Yeah, so they're running out of buildings to name people after. But I think at this point, no Fed chair, unless there was a really important reason, is going to end up dissenting. Their job is to bring the herd together, and they would find a reason to join that herd. If the chair dissented, that would be such huge news, upsetting to the markets, that I don't think they would risk that.
All right, really interesting stuff, Mike. We're going to be talking, I'm sure, a lot over the next couple of months about who Kevin Warsh really is. Thanks so much for your work all night. Bloomberg's Michael McKee, our international policy and economics correspondent. Let's continue the conversation with Annmarie Bowersock-Hill. She is CEO and founding partner of Bowersock Capital Partners. Annmarie, what's your take on Kevin Warsh as a Fed pick? I think he hasn't been the front runner until President Trump spoke last night, and he has historically been seen as hawkish.
Yeah, it's actually what I expected. I was surprised that Richter emerged as the front runner. I don't think, frankly, that he really wanted that job, and I think it's a relief that Trump selected Kevin Warsh. Yes, he was a hawk for a period of time when he was a member of the Fed. And he has become less hawkish over time, but I think it's probably going to reassure the markets.
He's a balance sheet hawk, right? So the concern is, does he try to unwind this balance sheet more than is necessary for such a gigantic economy? He started on the Fed in his first term in 2006. That's now 20 years ago.
Yeah, and I think one of the concerns I have about Warsh is that when you look at the very tightly aligned consensus we have this year about what is going to happen in 2026. I haven't seen a consensus that was this tightly aligned since early 2023, and we know how that went. I think the biggest surprise to the base case, to the consensus, would be if we saw reaccelerating inflation. And I'm not sure Warsh is in the position to handle that as well as some others might have been able to, despite his hawkish history.
How key is the Fed right now? Lisa Abramowitz on Bloomberg Surveillance brought up the point that, this market is focused on some other things, really. I mean, AI investment first and foremost, but also the resilience of the economy. And the Fed is pretty supportive as it sits.
Yeah, I think that is part of what the consensus is based on, is that we are getting so much stimulus from spending on AI infrastructure, fiscal stimulus from the tax bill, continued consumer spending, that earnings are likely to continue to grow, expectations are in the double digits, and that we're going to have a rising market in 2026. But again, I think there are some risks to that thesis that aren't being taken into account. Among them are the geopolitical risks out there and the danger that, that foreign investors are starting to lose faith in or lose trust in the U.S. and frankly, they're becoming reluctant to fund U.S. deficits.
So what's your view on stocks then? I mean, U.S. stocks first and foremost. Do we continue the incredible rally we've seen over the last 3 years?
Well, I hate to be boring, but our base case is, in fact, the consensus that we end up, due to all the stimulus that I just mentioned, with a positive year in 2026. I think the risk to that, the two historical parallels that we're looking to are 1994 and 2018. And in both of those years, the consensus was quite complacent about inflation. And in 1994, if you'll remember, inflation became more of a risk. The Fed surprised markets by tightening, and the bond market crashed, and the stock market essentially went sideways. And in 2018, inflation ticked up very modestly, and even that modest increase unnerved the markets enough that the market ended up down 20%. So I think what would happen if we saw even a modest uptick in inflation, which I think, frankly, is not unlikely. Again, it's not our base case. But if we saw the impact of tariffs finally flowing through into prices at the same time that we see a falling dollar, we see fiscal stimulus and continued strong consumer demand, and we have the issues, the labor immigration issues, which are putting upward pressure on services inflation, we could see an inflation uptick. And if that happened and the Fed were viewed as politicized and as failing to act, the bond market would frankly do the tightening for it. So I think that's the scenario that's probably not being taken into account.
So what supports the consumer? I mean, I get the AI investment thesis for the market, but it does seem like we're starting to see more companies use AI either as an excuse or as a valid reason for reducing labor. Is anything besides asset prices supporting consumer spending this year?
Well, I think that's one of the reasons the Fed paused, is I think there were a number of reasons, but there are lingering concerns about labor market weakness. And yes, the headlines certainly are about job losses. And I think that's a significant concern that the Fed should be worried about. You know, everyone's sick of hearing about the K-shaped economy. And, you know, frankly, we've had a K-shaped economy since the early 80s. But it's really the higher end consumer that's propping up most of the consumer spending. And that demand is unlikely to wane unless we have a big market sell-off, quite frankly. You know, the lower end consumer has essentially been living in a recessionary environment for decades.
Emily, great having you on. I can't help but look at the Flannery O'Connor novel behind you and definitely want to pick up and reread some of that work. Emily Bowersock-Hill, I get off topic a little bit. Emily Bowersock-Hill of Bowersock Capital Partners, thanks very much for joining us. Let's get a quick check on what's going on in the markets right now. S&P 500, it is down 0.2%, but look at the total, 69.54, still holding pretty high. NASDAQ as well, off 0.5%, but still at 25,761. In terms of the single stock stories moving this hour, Apple blew past earnings estimates, but says rising memory prices will impact second quarter margins. The shares are down, but you've got a couple of analysts out saying use this as a buying opportunity. SanDisk, its share action is still strong to the upside. 15% after an earnings outlook that was positive extended the massive rally we've seen, up 120% so far in January. And you can see that over the last year it's up hugely, 1,628%. SpaceX considering a merger with Tesla as well as one with XAI, and Tesla shares are up 3% on that news. Coming up, BlackBerry is helping BMW's new class of vehicles drive into the future thanks to its QNX technology. BlackBerry CEO Giamatteo coming up next to tell us more about all of the cars that they power. This is Open Interest. Let's get now to high interest. Look what's making headlines around the world. President Trump and Senate Democrats reaching a tentative deal to avert a U.S. government shutdown. Trump announcing the agreement and urging both parties to vote for it. However, a short funding lapse and partial government shutdown is still seen as the most likely scenario, with lawmakers almost certain to fail to enact the measure before tonight's midnight deadline. Here in New York, Mayor Zohran Mamdani is warning that Wall Street's booming year will not be enough to stave off a financial crisis, pointing to the concerns over the city's budget gap. In an interview with Bloomberg Television, Mamdani also weighed in on President Trump's plan to cut off federal funding to so-called sanctuary cities at the end of the month.
Our laws and our values are not bargaining chips. We are proud of what we have here in place in New York City. We will defend it, and we will defend New Yorkers. And look, the president said after our meeting in the Oval Office that the better New York does, the happier he is. And my job as the mayor of New York City is to make clear what these kinds of proposed cuts would do to this city that we both love. They would devastate this city. And so we're going to fight those kinds of threats.
Corporate America, meanwhile, digesting President Trump's announcement that Kevin Warsh is his Fed chair pick. American Express CEO Steve Squeri telling Bloomberg, quote, I think Kevin's a great guy. I know Kevin well. I think he's an excellent choice, and I think that his policies would be pro-growth policies. Let's turn now to BlackBerry. The company announced its QNX division software will be integrated into BMW's new vehicle generation, the Neue Klasse. The technology will support safety-critical systems across models as part of QNX's multi-year agreement with BMW. And not everyone knows that QNX software is in, I think, over 250 million vehicles worldwide. BlackBerry CEO John Giamatteo joins us now with more. John, you know, it's surprising. A lot of people hear BlackBerry and say, that company's still around. But as a car guy, I realize you're putting software into ECUs, into infotainment, into advanced driver assistance systems. Tell us how that business is growing.
Yeah, no, thanks for having me on the program, Matt. And yeah, we're actually up to 275 million vehicles that we power around the world with our real-time operating system. We're really pleased with the announcement with BMW, where we're taking that relationship to another level, and we're powering that with our advanced Ally Core capability. And this is an integrated kind of approach to really bringing together different layers of the stack. So our whole foundational vehicle software platform is powering everything that we do with BMW. And it seeks to really simplify the cumbersome and complex process of integrating software so our partners like BMW can focus more on delivering customer-facing applications that can build brand loyalty and differentiation. So that's the underpinning of everything that we're doing in the QNX, not only with BMW, but with all the other major OEMs around the world.
You know, as an American, I think of the major OEMs as like BMW, Volkswagen, Mercedes, Ford, GM. But of course, in China, there's a massive amount of EVs being powered by companies that most Americans have never even heard of. How does that market look? How does the TAM in China look to you as the CEO of a Western company?
Yeah, that's honestly, Matt, it's one of our fastest growing markets around the world. As you said, the explosion of EV, the explosion of technology that's going into these vehicles. Some of them have almost up to 500 million lines of code that are going in there, and an operating system like QNX with the software-defined capabilities, the safety certifications, which are increasingly becoming more important in a market like China, positions us really well for that to be a growth market for us in the future.
So is it helpful when, you know, the Europeans collaborate with the Chinese, or when the Canadians make a deal with the Chinese and they set up shop outside of that country and in places where you have more access to put your engineers?
It absolutely is. You know, the whole industry is really collaborating together. For instance, there's a company, a partner of ours in Germany, Richter, who's right at the forefront of us delivering this Ally Core solution. So you have a Canadian company, a German systems integration company, supporting OEMs in China, Korea, Japan, obviously Germany and the US. So it's a collaborative effort. Together is power. All of the industry really needs to come together and work harder as more advanced technology goes into the car.
We're looking at a slate of your partners, AMD, NVIDIA, Intel, and you put the software layer into this stack. Are you feeling margin pressure from the price increases for the hardware there?
We play on the software side alone, so the margin pressure on us, I mean, obviously OEMs are big, sophisticated companies that have large volumes that command, you know, a competitive price point. But I don't think it's the same level of pressure that maybe some of the hardware providers have. We have a deep relationship with Qualcomm, with NVIDIA, with NXP, Texas Instruments, Intel. So the entire ecosystem, from the tier ones to the systems integrators to the silicon providers, we work in concert with them to deliver our real-time operating system on QNX.
By the way, I think about these boxes with 4 wheels that people buy and drive around just because I'm older. But a younger person would think about robots, or at least AVs. And I know you're also in medical devices. I mean, it seems like your software can power a whole host of devices. What's most interesting to you, or what's the biggest revenue driver for BlackBerry outside of automotive?
Yeah, 100%. A lot of the work and the development that we've done in the auto side of the business translates very nicely to the general embedded market. You know, verticals like medical devices, railroad applications, robotics is a particularly high growth segment. These are mission critical environments where system failures have life-threatening consequences. So a real-time operating system like QNX is purpose-built for those kinds of applications in solving those business problems. So robotics, medical instrumentation, industrial automation, we think that's the next frontier of growth for us in this industry.
What's your pitch to investors, John? Because the stock has languished. I mean, it's just gone nowhere really for the past couple of years, even with your dominance in industry, in the auto industry, and growth in others. So how do you sell the stock to investors?
Yeah, we think we're really poised for growth in the future, Matt. It was one of these, the transformation that we underwent over the last couple of years. We divested subscale and unprofitable business. We simplified our operations by reducing layers and empowering the workforce and removing bureaucracies. That enabled us last year to get back to profitability and generating cash. Now we're really focusing on accelerating our growth into 2026. And as we accelerate our growth in the coming years, I think that's really when the stock is poised for a breakout.
All right, John, pleasure having you on the program. Thanks so much for joining us. John Giamatteo, they're the CEO of BlackBerry, the owner of QNX, and they power now 275 million vehicles around the world, but are getting into medical devices and robotics as well. Still ahead, a big sales beat for Starbucks, stoking confidence in CEO Brian Niccol's turnaround plan. He joins us with Romaine Bostick to discuss next. This is Bloomberg Open Interest. Going to check on the stock market right now using the move function on the Bloomberg terminal. You can see the S&P 500, a little bit of volatility here, but down 0.3%, about 20 points to 69.50 if you round up. So still pretty close to that 7,000 level. Breadth is bad. You can see 349 stocks here down, only 150 are up. On the upside, you do have Tesla on reports that it's in talks to merge SpaceX. Verizon Communications had its best quarter in terms of subscriber ads since 2019, so pre-COVID, and they're buying back $25 billion worth of shares. So that stock up 8%, SanDisk up another 13, bringing its total gain this month to 140%. On the downside, Facebook is off almost 2.5%, taking 4 points off the index. KLA down 10%, 11%, taking 3 points. Apple also is down only 0.5%, but that takes 2.6 points off. The only gaining industry group is consumer discretionary stocks. Everything else is down right now. And speaking of consumer discretionary, Starbucks CEO Brian Niccol joins us next with Romaine Bostick as the coffee giant's turnaround starts to take hold. Since taking the helm at Starbucks in September 2024, the CEO, Brian Niccol, has launched a multi-pronged turnaround plan. Its latest results show that plan is gaining steam. Romaine Bostick, co-host of The Close, is with him now. Romaine?
All right, thanks, Matt. Yeah, I'm here right now with Brian Niccol, fresh off his investor day here in New York City, and fresh off an earnings report that actually seemed to please a lot of investors. You're 5 quarters right now into your tenure as CEO of Starbucks, and you put together a couple of quarters of growth, something that the company hadn't seen in quite some time.
Yeah, it was a great quarter for us. You know, the thing that was really exciting is to see the growth was driven by transactions, and also the fact that the initiatives that we put in place around operating, supporting our partners with the Green Apron service model, and then really getting back to great customer service I think really it showed up in the results this last quarter. So we're pretty excited.
So when you say transactions, are you getting more people in the store?
Yeah, that's exactly right.
Yeah.
So what was great to see, too, is the growth in transactions came from existing customers that are in our rewards program, as well as customers that are not in our rewards program, that frankly we had been struggling to kind of reclaim momentum with that group. And in this quarter, we had both groups growing in visits, and as a result, our market share increased in visitation as well.
I'm curious about the actual amount of money that they're spending. As far as the growth in tickets, that was actually a little bit underpacing what you actually saw in transactions themselves. What explains that?
That's right. So, we saw about a little less than a point of ticket growth, and that's really driven by the fact that we've launched this new program around protein. So you can get a protein cold foam on any drink, and that's a modification. And then obviously the balance of the growth came from just more people coming to Starbucks either more often or coming back to the brand that hadn't been here in a while.
Now, since you took over, you've put a big emphasis on, I guess, reimagining the stores to a certain extent. This may seem like a dumb question, but why? I mean, when I look at where your revenue comes from, a lot of that is coming from the drive-thru. It's coming from takeout on the apps. It's coming from delivery. But you've put a big emphasis on the in-store experience, and I don't understand why.
Yeah, sure. Well, thanks for the question, because I do believe Starbucks is defined by the cafe and the coffee house experience. That really is where you get the human-to-human connection with our baristas. It's where you see the craft of Starbucks, and then you also get just the soul of Starbucks. So, our in-store business is still over 20%. The thing that I always like to remind people, too, is people access Starbucks in all these channels. So they may go via the drive-thru or mobile order Monday through Friday, but Saturday, when they've got a little bit more time to dwell, they want to hang out in a great space. And so just this past month, the data I saw is 60% of our customers made at least one purchase from the counter. And that doesn't include our mobile order pickup people that come into the store to pick up their coffee or their drink or their food. So, obviously the entire business works because we have the right access modes, right? Mobile order pickup, delivery, drive-through, and then obviously the in-cafe. But I just believe the cafe experience and this idea of a community location, the third place, it's critical to people and it's critical to what makes Starbucks Starbucks. It's who we are.
And you think that's what customers want? Because we've seen some new entrants into the coffee space, both domestically as well as some folks like Luckin coming to the U.S., taking a much different business model, basically grab and go, more or less.
Yeah, the thing I like to remind everybody is we actually execute those channels, right? So we have a mobile order pickup business, which is one of the competitors. We have the biggest drive-through business. It's well over a $10 billion business. It actually would be a Fortune 500 company just on its own. So we know how to operate and give great experiences in all access modes. What we've seen over and over again, though, is when we have all these channels with a great coffee house, we really are unmatched. And so that's our point of difference. And that's not to say we can't be great in these other access modes and compete effectively.
I mean, that sounds great on paper, but that sounds also complex. I mean, how do you maintain the integrity of everything when you're trying to have this experience in store at the same time somebody who wants to grab and go or a delivery driver showing up to grab an order as well?
All right, and that is why it's so important that we get this green apron service model dialed in. And really at the foundation was making sure we have the right number of people on the roster, the people are deployed correctly, our partners then know what they're accountable to execute. And what we've been able to see is between technology and I think simplification of the actual operating model, our partners can do a great job. A cafe experience happens in less than 4 minutes from order to drink with a personal handoff. Mobile order, we're more on time and accurate than we ever have been. And our drive-through during peaks are below 4 minutes as well. So it can be done, but we have to be intentional about it. And, we have to set our partners up to be successful to operate that omni-channel experience. I love the fact that we're seeing the success that we're seeing. And I love that, people are talking about the Starbucks experience again, like that shine, that soul that really is magnetic.
That vibe. I think one of your executives said yesterday at your investor day is back.
Yeah.
The cultural relevancy for Starbucks, that's back?
That's back as well. Our marketing, our menu innovation, One of the things we set out to do as part of this turnaround is get back into culture, get back to leading culture. And you got to do that with the right drinks, the right food, and then frankly, the right representation of the brand, showing up in the right places at the right time with the right communication. And Tressie Lieberman, who leads our marketing efforts, she's done a phenomenal job. We are, in my opinion, Starbucks is back.
Well, speaking of her, at your investor day yesterday, she talked a lot about your rewards program. It's relaunching, being reimagined, I believe, in early March. Talk about the need to retain your existing customer base, but how that rewards program helps, if at all, in bringing in new customers, those who aren't exposed to Starbucks on a daily basis.
Yeah, so look, we got a lot of feedback on the rewards program. It's been a great program, but the feedback we got was it's not very personalized. And so really what the team has done is made it more personal. And the feedback we get from people that don't participate is like, look, maybe I don't go to Starbucks with enough frequency to really benefit from the rewards program. We're changing that because now when you get into the green tier, and there's 3 tiers now, so you're gonna have the reserve tier, the gold tier, and the green tier.
And reserve is the top.
Reserve would be the top. You'll actually get a black reserve Starbucks card, which will be pretty cool because everything seems to be so virtual anymore. I think people like every once in a while to get something tangible. But the green tier then allows you to redeem stars, and you can get a reward with not that much engagement. And so it just gets people to be more connected to the brand. And then ideally over time, they'll migrate into gold, or for some of those folks that migrate into reserve, I think they'll find it's a really special experience.
You've managed to sort of get sales back up. There are still some analysts that look at some of the growth rate that you have. 4%, I think, was in the most recent quarter.
That's right.
I think your guidance is, 3 to 5%, a little bit longer term. But there are some analysts that are looking back to the heyday from a decade or two ago when Starbucks was more mid-single digits and even up into the teens. Is that even realistic to get back to those levels?
Look, I've looked at this as I've come in, and a company at our scale, we have 40,000 coffee houses around the world, over 400,000 Green Apron partners. I think if we can consistently deliver a comp that is 3% or better, revenue growth that is 5% or better, and then earnings growth that outpaces that, that would be world-class. And we're a world-class company, and we will deliver, I think, world-class results as we get going on this turnaround. So make no mistake, we are a growth company at scale, which is really exciting, I think.
On the top line, when does the bottom line catch up?
So the bottom line, you'll start to see us make improvements, I think, as we get into the back half of this year and then every year from here on out. And that's really what we guided people towards is we'll get into the 13 to 15% range on margins here by 2028. And then actually, that's just, I think, a mile marker. There's opportunity for us to grow even beyond that.
What's holding back that margin expansion, that profitability right now?
Look, initially we had to do some reinvesting in the business to get, again, the right people. We invested over, I think it's $500 million, close to $600 million into the labor experience. And, the best way for you to then start driving earnings is we got to get the top line going. We've done that. And then obviously we'll work on the middle of the P&L as well, on the cost side of things, which we've got clear line of sight on how over the next 2 years, we'll probably be able to save close to $2 billion while we're growing the top line. So it's a combination of growth and smart cost management.
I am curious, at least here in the U.S., with regards to those growth plans, how much have you taken into account the economic environment? I mean, a lot of your products are still, if not premium, certainly perceived as premium priced products here. Does that work against you if we do end up in an economic downturn?
Look, I think at the end of the day, the thing that I'm excited about is people are saying the experience they're getting at Starbucks, the whole package, they're saying it's worth it. And we're seeing some of our highest scores through consumer claimed statements. And that's why I think it's so important that we have this great cafe experience. We have this great customer experience where it's a connection between our barista. And then look, we've always been unwavering in the quality of our coffee, our drinks, and the ingredients that we use. So yeah, we're going to be an affordable luxury item. But if you look at it, we're priced pretty darn competitively. And then I think for what you get, for the premium that we provide, I think customers are saying, yeah, I'm all in on that.
Do you think you have that pricing power right now? Should you feel like you need to pull that lever?
Look, pricing is one of those things that will always be the last lever that we'll pull. There are times where you do have to put some pricing into the business, but fortunately we've been able to hold off for the last little more than a year. So we'll see how things evolve. But, if we need to do it, we'll do it very strategically, and we'll try to do it as minimal as possible.
You're spending a lot to revamp your stores. I know that's a temporary cost in theory, but there are other additional costs you're having to deal with, including labor costs and things that are going to be more longer term and permanent. How is that factored into the forecast?
Yeah, look, obviously you always have to think through what does it cost in order to make sure we maintain the integrity of the experience. And right now we're having to come back in, we call it our Coffeehouse Uplift program, where we are just basically retouching all of our cafes. So we want to have great seats, great atmosphere, a place that feels warm, a place you want to be. And then obviously we have been and will always be some of the best benefits, best wages you can find as a partner. And so when you look at it in retail, there's no doubt we have one of the best jobs in retail. And that's the reason we can also see it is we have the lowest turnover in our industry by a lot. Our turnover is below 50% at the hourly level. In this industry, turnover is usually over 125%. So we're definitely doing something right.
Yeah.
And the feedback I'm getting from our partners is they definitely feel supported, they're engaged, and they love doing the work that they're doing.
I am curious, though, about some of the unionization drives that kind of predated you, but are obviously still there as well. Have you spoken with those unions in any sort of meaningful way recently? Are they still demanding more than what you've already offered?
Look, I think we've talked about this. I'd love to be able to find a deal so that we could, get a contract and move on. But it's going to have to be reasonable, and it's going to have to reflect the fact that we are the leader in benefits, wages for people that work 20 hours or more in our company. Because it has to be sustainable so that all 400,000 partners and all 250,000 partners in the United States can continue to have a great experience, a great career, and frankly get great development and growth personally and professionally. So we're always going to continue to have the conversation, and I'm a believer in that you can find a solution, but it's going to have to be reasonable so that everybody can be successful long term.
The U.S. is obviously your primary market, but Starbucks for quite some time and made a real big push into China. At one point, you were the largest coffee chain in China. You've retrenched from that just a little bit, and you've recently entered into a partnership to effectively sell off the majority of that business to the private equity firm Boyu. What is Starbucks going to look like, particularly in China and the rest of the countries? Yeah,
look, I think the one thing I want to be clear on is we do believe China is a tremendous growth market. Today we have over 8,000 coffee houses. We believe with our partner Boyu, that could be 15, 20,000 coffee houses. And they are a great partner for growth. And part of the reason why we decided to do this is for our next chapter of growth, we just believe we needed a local partner to help us kind of figure out how we can grow faster. Because one of the things that has really, I think, been exciting to see, and on the other hand, kind of like, whoa, is the coffee category is really growing. And, some of these competitors that have emerged in China have just, I think, really ramped up their new unit growth. And so we're going to have to get more competitive in our new unit growth story. And I still believe at the end of the day, we have the best product and the best experience. So I believe that'll set us up for success. And I think that's why Boyu is so excited to partner with us, because they see the opportunity as well.
You talked at your investor day about this being sort of an asset-light model that you're taking there. Does that also mean that investors should expect maybe slimmer margins because of the fact that you have to share a lot of that money with Boyu?
No, and look, the way we've structured it is, obviously, the partnerships are in the cases where we have full license scenario. We don't end up deploying our capital into the markets. We support the licensee in a different fashion through, marketing and menu and technology and, design. So it just becomes less of a requirement on our capital. But it's still, in most cases, you see the margin actually rise and becomes margin accretive to the total business. And the thing that's really exciting is there's so much opportunity for growth. Yeah. And when you have these local partners in these international markets, we just end up, I think, getting access to the premier real estate, and at a speed that we couldn't do from our Seattle offices.
I am curious about the scale of this business, particularly in light of some of the businesses that you ran before relatively successfully. For those who don't know, a former brand manager at P&G, you went on, turned around Taco Bell, you turned around Chipotle, now you're just Starbucks. Is Starbucks too big to handle right now?
Oh, no. The thing that's great about Starbucks is the brand is beloved. It's iconic. And when you go around the world, there's no doubt that people want to engage with the Starbucks brand. I was looking at the U.S., I think we just moved too far away from what made Starbucks Starbucks. And I think you were at our investor day yesterday, and I think Mike said it really well, which is we don't need to change who we are. We just need to be great at who we are and what we do. And that's what we're getting back to doing intentionally, right? So it's like we're going to be intentional about that barista to customer interaction, the customer experience you get. We're going to be intentional about making sure you have a great seat. We're going to be intentional with the menu, the marketing, the digital experiences that we provide. And what I've seen just most recently from this quarter is when we do that with excellence, we get rewarded with customers' business and loyalty.
And you're going to be intentional about the locations. I mean, under your predecessors, there was a big expansion plan where, at least here in New York City, I mean, you can walk down a single block and have like 5 Starbucks, all competing against each other. That's retrenched a lot. Do you go back to that?
Well, look, I think there are opportunities for us to continue to grow in New York City and, frankly, in a lot of communities around the United States. We talked about this yesterday. We believe we can add 5,000 stores. We've got line of sight on that. And as we grow our afternoon day part and grow the economics of the business, we'll probably go well beyond those 5,000 that we've identified. So you'll see Starbucks continuing to bring new stores. We want to be smart about where we locate them so that it's the right place for the customer, most importantly, and then also so that we can attract and retain partners to have a great experience working in the stores.
Most of your revenue is still weighted to the morning. You mentioned the PM, if you will, afternoon. What actually gets people not only in the stores in the afternoon hours, but also spending more?
Yeah, well, so we have an afternoon business today, but I think there is a multi-billion-dollar opportunity to grow our afternoon day part. As we get the cafe set up to be a great place for you to, kind of reset, recharge, whatever you want to do, and we pair that up with the right beverage and ultimately the right food, I think there's no reason why we can't have as strong of an afternoon day part as we have in the morning.
And speaking of food, you are making some major menu changes. One thing I noticed at the Investor Day, there were a lot of non-caffeinated beverages now that are coming down the menu. Why?
Well, I think we were sampling a lot of the things that we think are going to be right for the afternoon. And, we talked about our new energy refresher platform where you'll be able to do, completely decaffeinated to what is our standard caffeination and then add a little bit more and you'll be able to customize this. So, we want to have the right drinks for you, whether it's morning or afternoon. And what we're seeing is in the afternoon, some people in certain cases aren't looking for caffeine. In other cases, they're actually looking for more caffeine. So we need to be able to provide it all. And the thing that I love about Starbucks is personalization / customization is at the core of who we are and what we do. So I'm really optimistic about what we can do with food and what we can do with beverages to be on trend, right? Protein, fiber forward on the food side of things. And then on the beverage side of things, giving you that personalization so that you can get the flavor experience that you want with the energy experience that you want.
No olive oil?
Not right now.
All right. Brian, you've done a good job so far, and investors are going to demand a lot more. You've done a great job turning around other companies. I just have to end this by asking you a really hard question here. Miami University. You guys are 21-0. First time you guys have really kind of been contenders since the Wally Szczerbiak area. Is this going to be that year where you guys get back to the NCAA?
Look, it is as an alum of Miami of Ohio. It is great to see the success the team is having and Coach Steele is having. I was at Miami. I graduated in '96, so. After I graduated, we had that great run with Wally Szczerbiak, and it was fun to see. They got to the Sweet 16. It's fun to see the students having a great time, and it's fun to see the school on the national stage. It's a great school. I've got great friends, great memories, so it's fun to see them having success, and I'll tell you what, I'm watching every game and rooting really hard.
All right, Brian, we'll really appreciate you being with us here. A turnaround going on right now at the Miami University and a turnaround at Starbucks. Matt, back to you.
Romaine, thanks very much. Romaine Bostick, their co-host of The Close with the CEO of Starbucks, Brian Niccol. Let's turn back now to our top story. President Trump's Fed chair pick is facing opposition on Capitol Hill. Senator Thom Tillis says he will block Kevin Warsh's nomination until an investigation into Jerome Powell is over. He spoke on Bloomberg Surveillance.
We'd still have a working quorum of members. Whether or not they have an acting chair is a decision that the president and I assume the Treasury Secretary and others can look at. But that's not my problem. We're here because of them. We're not here because of me. And so I think they should work expeditiously if they really do. I'm not an attorney. I watch a lot of crime shows, but it doesn't look like there was any criminal intent here. They have to determine whether or not it's worth grinding this out.
Joining us now is Philip Richter. He is president and co-CIO at Hollowbrook Wealth Management, joining us on set. Philip, great to have you here. And I think, Senator Tillis made clear that he is not opposed to Warsh. In fact, he thinks he's probably a great choice to run the Fed. It's about the process. It's about defending Fed independence. So I guess eventually it happens. What's your take on this new head of the Fed?
I think he's an impressive guy, right? He's got a long track record, both in the private sector and in government. He's done what he said he would do. He's been very consistent. I think he's a bit of a surprise choice, and I think he would do a great job.
Seems like the market is taking him as a hawkish choice. We had, we're only off 0.2% now, but futures were down 1% when we started talking about this last night, this morning, and the dollar has strengthened. Yep. Is that necessarily a bad thing? I mean, the terminal rate comes up a little bit. The economy is running fairly smoothly, and the AI investment case is strong.
Yeah, but I think there is this outstanding concern about the debt levels, both in the U.S. and globally. I mean, globally, $100 trillion or $300 trillion of debt with $100 trillion of GDP, roughly. There is concern among market participants about this debt burden, pretty much mostly on the public side of things, the government side. I think this nomination is giving everyone a little bit of pause and happiness.
So how are you at Hollowbrook and your investors investing around this? Because we're still looking at all-time highs on the stock market. We're looking at almost record tights in terms of spreads over treasuries. And the 10-year, frankly, isn't bursting out. It's still at 4.25.
Well, what a time to be alive, right? As a passionate investor and a student of markets, I don't think there could be a better time to be alive with all the things that are going on. The S&P at an all-time high, gold at an all-time high, silver at an all-time high, corporate profits, earnings at pretty much an all-time high, but debt at a huge all-time high. So once you get this bifurcation of things seem to be going really well running with businesses in general, but you've got this mountain of debt where we have almost a third of government debt of the U.S. has got to be refinanced in the next 12 months. We've never seen, that's never been done before, right? It's a lot of debt. Right. So, I think it's about, for us at Hollowbrook, we don't change with every day and pivot and do things. It's about fundamentals, sticking to basics and sticking to your principles. So, liquidity is really important. Quality is really important. Diversification is really important. And really sticking to your principles.
On the diversification front, this is what I've heard from a lot of investors recently about gold, although it's been stunning, really, to watch the rise in price. Are you investing in gold? Are your clients investing in gold?
We've always been invested in gold. The only problem we have now is our position in gold has become too big for our portfolios. So we have to think about what does that mean, right? I think the rise of gold is stunning for two reasons. One, how sudden it was. Although, if we were in January of 2020, gold was around 1,500. It's now close to 5,500. But I think what's even more stunning is what gold mining companies are up against here, right? More complex geology, difficulty in mining in very difficult jurisdictions, environmental restrictions. So there is going to be no supply response. If every institutional investor in Midtown pushed the button for 1% in their portfolio, I don't know where the paper market, yes, the futures options, but the physical market, it's very hard listen to the earnings call of major well-run mining companies, Newmont, Barrick Gold, Agnico Eagle. These guys are having a tough time.
I would be remiss if I didn't ask you about cars. That's how we know each other. You're on the board of the Revs Institute with Miles Collier. You had the Turtle Invitational at the Coker Farms in Bedford, a great car show. We've seen amazing prices paid for a 250 GTO at 38 million and change, an Enzo at 17 million, right? A 288 GTO at 11 million. Is that also part of this diversification and the debasement trade? People looking to do something else with dollars?
Unequivocally. And now look, the Bachmann car that sold at Mecum last weekend, that Ferrari Enzo was as perfect gets. Very low mileage, hermetically sealed, all the bushings, everything was perfect. But 17.8 million for that car. Those cars were in the threes a year ago, bumping up to 4.5, 5. And a leap upwards to that kind of price tells you that that buyer obviously wanted the car, but is thinking about that as an asset. And it is. The collector vehicles are unequivocally a true asset class. Now, many of my clients look at their holistic life, and we've got our real estate, we've got our equities, we've got our muni bonds, and we've got our car collection. Right?
So what's next? I mean, you've already seen a generational shift, and we've only got, 20 seconds.
Yeah.
But we've gone from 250 GTO now to Enzo. What's next?
I think you just continue to see a rise of the highest quality, lowest mileage, original examples, or vehicles that have unbelievable provenance. They might not be perfect, but if they were driven by Schumacher, right, and won a race, that's an important vehicle. They're going to keep going higher because I don't see the dollar debasement trade stopping, right? Our government, Doge has failed, right? We're not going to be cutting costs. The big beautiful bill adds trillions. And there we go.
It's all about diversifying away because of debt. Philip Richter from Hollowbrook Wealth Management, thanks very much for joining us.